So in example 2, we are looking at the example on ADB Limited. Here we are told that ADB disposed of an item of plants for 250,000 naira. The plant originally cost 500,000 and accumulated depreciation charged up to the year of disposal was 150,000 naira. You are required to present the transaction in the statement of cash flows for ADB Limited. Now, basically what we want to do is to adhere to the presentation requirements in IS 7. First and foremost, I've always insisted that when students are asked to present the statement of cash flows or prepare the statement of cash flows, you should always start with the name of the reporting entity. Here, the name of the reporting entity is ADB Limited. And then we move to statement of cash flows for the year ended XXX. Then we move to cash flows from operating activities, and then remember we have to adjust operating profit or profit before tax for the loss on disposal. We are going to be calculating the loss on disposal of 100,000 as follows. The first step is to identify the cost of the plant. The cost of the plant based on the question is 500,000 naira. Then we less accumulated depreciation of 150,000 naira to arrive at a carrying amount of plant of 350,000 naira. Then the cash proceeds from sale of the plant is 250,000 naira. And if you look at it very closely, you see that the cash proceeds from sale of this plant is less than the carrying amount of the plant. What that means is that assuming we are the reporting entity, that is, we are ADB Limited, we have recorded a carrying amount of 350,000 naira of plants, and when we sold these plants, we recovered less than the carrying amount. That means we sold at a loss. Therefore, we have to recognize the loss on disposal as a non-cash item in the statement of cash flows. And that is why we are adding back 100,000 naira to the statement, to operating profit or to profit before tax, as a non-cash item. Then we also need to recognize the cash proceeds from the sale of the plant of 250,000 naira. This cash proceeds from the sale of the plant is recognized as an investing activity. Now we move to the next item that students normally have issues with in the statement of cash flow, and that is deferred taxation. When we talk about deferred tax arises from timing differences between the carrying amount of assets or liabilities in the financial statements and their tax base. Deferred tax movements do not involve actual cash flows. They are not shown as a separate cash flow in the statement of cash flows. Rather, deferred tax are adjusted for when reconciling profit before tax to tax generated from operating activities. It is important to note that in the indirect method, if you start with profit before tax, you would have to add back deferred tax expense if it was deducted before arriving at profit before tax. You will also need to subtract deferred tax income if it was added before arriving at profit before tax. The adjustment ensures only that current tax paid, that is the actual cash, remains in the operating activities. Also, what that implies is that if we have a question where profit before tax is 500,000, then we have to adjust for depreciation 80,000, deferred tax expense 15,000. We also have to adjust finance cost 20,000. Operating profit before working capital changes is therefore 615,000. Here in the question, the deferred tax expense of 15,000 naira is added back because it is not a cash item and it does not result in a cash outflow. In the direct method, students will not be required to show deferred tax at all, because in the direct method it is only the actual cash tax paid that is recognized under operating activities. Hence, in the indirect method, the 15,000 naira deferred tax expense is added back. but in the direct method, there will be no need to do that because no cash actually left the company for it. Let us look at some of the tax paid disclosures. IS7 requires the disclosures of income taxes paid. When we talk about income, we talk about the current element of the company's income tax, either in the operating section or in the notes to the financial statements. And this is separate from the income tax expense in the profit or loss, which includes both current and deferred tax elements. The formula for tax paid is explained using the subsequent ledger. Now let us quickly look at a typical ledger depicting how tax is paid or depicting how tax is recognized. So in the ledger, for example, we open an account called tax payable account. And this tax payable account in the ledger, see a typical example of tax paid. Using the tax payable account to calculate tax paid, we are going to be opening our tax payable account as follows. And to our tax payable account, we are going to be posting the opening amount of tax liability as well as the closing amount of tax liability. So having said that, let us just use this ledger to depict what we are talking about. Now, to calculate tax paid, first and foremost, we will need to post tax paid to the tax we will need to post the opening and closing balances of tax payable. So that will lead us to this. We post the beginning balance, that is the balance BD, and assuming the balance BD is 100 and balance CD is and balance CD is 80, then the actual tax expense for the year, is 20. So when we balance this account, we are going to be having 120. Let's do auto sum. That's 120,000. Then 120,000 will also come here. That means that the balancing figure is 40. We call this the actual tax paid for the period. So the actual tax paid for the period is going to be 40 naira. And because this is going to be the amount that we are going to be recognizing as an operating line item in the statements of cash flows. Now, we are actually interested in calculating tax paid, and then we have to go back to our question where we are interested in calculating the tax paid based on the example given. And remember that I mentioned that to prepare tax paid, we need to open a tax payable account, right? So, having said that, we are going to also see more examples. But before we see those more examples, let us note that when we talk about deferred tax is a non-cash item, and we need to adjust for it when reconciling under the indirect method. Deferred tax is not a separate cash flow item. So only the current tax actually paid is going to be recognized or recorded as a cash outflow under operating activities. Let's now look at an example. We have the extract from the statement of to the from the financial statement, that is the statement of profit or loss for 20x4. We have profit before tax 500, income tax expense current 90,000, income tax expense deferred 15,000, and we have profit after tax of 395,000. naira. Then the next information we are provided are the changes in the financial position items. We have current tax payable at the beginning and at the end. We have deferred tax liability at the beginning and at the end. We have to start preparing our statement of cash flows for the year ended 31st December 2024. We start with profit before tax of 500,000. Then we add back non-cash items such as depreciation, amortization, and deferred tax expense of 15,000 naira. We also add back the deferred tax expense because there is no outflow of cash. So that is going to be giving us profit before tax, add depreciation, add deferred tax expense to get the subtotal before working capital changes of 595,000 naira. Then we adjust for working capital changes. After adjusting for working capital, before adjusting for working capital changes, note that working capital comprises of current assets and current liabilities, except cash and cash equivalents and bank overdrafts. Then we calculate tax paid using the current tax movement. The current tax expense is 90,000. Then we add the opening tax payable of 25,000 and less the closing tax payable of 18,000 naira. Therefore, the actual tax paid is 97,000 naira, and this 97,000 naira is an actual cash outflow and is deducted from in the operating section of the statement of cash flows. Therefore, the actual statement of cash flows is presented as follows. The actual statement of cash flows is presented as follows, where we have profit before tax 500,000, we have depreciation 80,000, we have deferred tax expense 15,000, we have operating profit before working capital changes of 595,000 naira. We don't have any changes in working capital given to us in this question. Therefore, we have tax paid of 97,000. The resulting amount is calculated as 498,000 naira. Therefore, we say that deferred tax is not a cash flow. Therefore, it is added back if it is an expense or deducted if it is an income in the reconciliation of profits to cash flows.